Good morning. Apologies for the technical difficulties this morning, but we are ready to kick off. Welcome to today's session on the TwoPot system. To my left, well, first of all, let me introduce myself. I'm Janice Mazenkamp. I'm Head of Retirement Fund Consulting at NMG and your host for today. To my left is Leanne van Beek. She's the Director at ICTS Legal Services. Leanne's going to take us through the legalities of the TwoPot system. And then to Leanne's left is Natasha Haggett-Henshey. She is the Principal Consultant and Actuary at NMG, and Natasha will be taking us through the actuarial aspects of the TwoPot system. I'll then end off the webinar with just taking you through on some of the aspects on getting ready for the TwoPot system, and we'll be answering questions as we go through the sessions. I'm going to hand over to Leanne.
Thanks very much, Janice, and thank you for having me to speak today. So perhaps just to say, please add your questions in the chat and we'll answer them as we go. And then Janice has let me know that the slides will be available after the session, and so will the recording. So you don't need to make mad notes today. All right, so if we get into the slides. Okay. I'm going to take you through for about the next hour how the TwoPot system is working at the moment. So the final version of it is still to be seen. We haven't seen it yet. This is the next version of it. So we saw the next version of it on the 9th of June 2023. It is extremely technical, right? There's lots of changes to be looked at. And those changes include not just changes to the Income Tax Act for the TwoPot system, but changes to the Pension Funds Act as well, because of course the Income Tax Act and the Pension Funds Act have to work together. As I'm talking, please remember to add your questions in the chat, because after each speaker, we're going to take questions. If we are aware that we're going to be dealing with that question in as part of what we're saying today, then we won't answer it and we'll just let you know that. Okay, so we've still got a way to go on TwoPot. Treasury is holding workshops from the 6th to the 8th of September. It's still got to go through Parliament. There will still be open hearings on it. So TwoPot could still change, right? We know that. So everything that we're saying here today is likely to still be up for debate, but we hope it'll be tweaking and not major changes. If you hear us talking about components or pots, they mean the same thing, right? A component is a pot. So if I say savings pot or I say savings component, that means the same thing. Right, so if we look at the TwoPot system, there are two conflicting aims that the legislation is trying to achieve. The first one is that subject that rose during COVID, which is access to cash. So we don't want employees or members leaving the fund to access their benefits because they are desperate for cash. So the idea behind TwoPot, one of the ideas behind TwoPot, is that we give members access to cash while they are still in employment and they're still members of the fund. The other aim, and it is a conflicting aim, is to, of course, ensure that members have more money when they reach retirement. And one way to do that is to ensure that there's a part of the member's benefit that is stuck in the fund until they retire, or of course die. So you've got these two conflicting aims: access to cash while still in employment, and then keeping enough money in the fund for the member until they retire. And Treasury wanted to achieve both of those with the TwoPot and not just one. Okay, so if we look at the three pots, what I'm going to do first is just give you an overview of the pots. Then we're going to look at what comes into the pots, and then we'll look at what comes out of the pots. Okay, so there we go. So if we look at the three pots, the first pot is the vested pot. Now, this pot is fairly easy in that It is made up of just everything that the member had in the fund as at the 29th of Feb 2024. So we've got 29 days in Feb next year. It's the day before this legislation comes into effect on the 1st of March 2024. So everything that the members built up in their fund as at the 29th of Feb 2024 is in their vested pot. Then we get 2 new pots. So after the 1st of March 2024, when the legislation comes in, we get 2 new pots. Okay, the first pot is the savings pot. Now this pot is the pot that money is going to leave while members are still in employment. Then we've got the retirement pot, and that pot is the pot that members have to keep in the fund until they retire, or of course until they die. Okay, so those are the 3 pots: the vested pot, savings pot, and the retirement pot. Then we've got something called seeding. So if you hear the word seeding, this is what it means. How much of my money as a member that I've got in that fund, that I've built up before this legislation comes in, can I have access to on once this legislation is effective? So I've built up money in the fund already. Am I going to be able to access that money? Now we know that Treasury has been in 2 minds about this, because in the first version they allowed seeding, in the second version they didn't allow seeding, and now in this last version they have allowed seeding again. So if we look at our pots again, what is seeding? So what it is that the vested pot, as at 1 March 2024, an amount will come out of it into the savings pot, and that amount is 10% of the vested pot, capped at 25,000 Rand. Okay, so if we think about that, let's do an example. Say on the 29th of Feb 2024, I've got 300,000 Rand in my fund. Okay, that's what I've got as a member. At that stage, as of the 1st of March, 10% of my 300,000, 30,000, capped at 25,000, thus 25,000 will go into my savings pot. Okay, so that is automatic. There is no discretion. The fund can't decide yes or no, we're going to do this. The member can't decide yes or no, we're going to do this. That happens automatically, which is one of the reasons why NMG is working on the changes to administration systems and other types of system and documents. Okay, so that's what seeding is. Very simple. Right, so what I want to look at now is what goes into the pots. All right, so when I'm talking, if you're thinking, okay, how does a death benefit work, or retirement benefit, or whatever the case may be, we are going to talk about that, but first we're going to talk about what goes into the pots. So let's build it up slowly. So we've got our 3 pots, right? Same 3 pots: vested pot, savings pot, and retirement pot. So the first thing that we know is that contributions from the 1st of March 2024 are going to be split between 2 pots. Okay, but even before that, we've got our seeded amount. Okay, so remember what I said about seeding? 10% of the vested pot, subject to a maximum of 25,000, so capped, goes into the savings pot, right? So that's the first thing that we find in the savings pot on the 1st of March. Then our contributions go in after the 1st of March. And our contributions go in 1/3 to the savings pot and 2/3 to the retirement pot. You don't get a choice about that. So remember, the previous version said you could choose that percentage. This version is different. Okay, so you don't get a choice about that. It's automatic, 1/3, 2/3. Now you will see I've got there all slash total contributions, minus expenses and premiums. So what I mean by that is all your premiums come together. So whether that's employer, employee, whether it's an additional voluntary contribution, makes no difference. They come together. Then your expenses, like admin fees as an example, and your premiums, for example, approved risk benefits, come off first, and then that split is done between 1/3 and 2/3. Now, why would they do that? because they don't want those expenses and premiums coming off disproportionately from one pot. Okay, so far, we've got our seeded amount coming in, we've got our contributions coming in. We're going to do one exception to where contributions are contributed later when we deal with our older members. But at the moment, understand that the basic principle is that after the 1st of March 2024, our contributions are split between the savings pot 1/3 and the retirement pot 1/3. Right, then of course, we get investment return on all three of those pots. Okay, so we know that investment return will come in as it does now. Then you will see on the right-hand side of the screen there, I've got the investment return and amounts credited. Now that's a funny little phrase that just means we're going to allow as Treasury for bits and pieces to come into the pots if they need to. So say, for example, you do a surplus distribution or reserve account distribution, whatever it is, and you've got little amounts that are payable to your members, those can come into the pots as well. The legislation doesn't say how they come into the pots or in what percentage, etc., but it allows for them to come in. And those are all your bits and pieces. Okay, so we've got seeding, we've got contributions, we've got investment returns, and these funny little amounts credited. What else comes into these pots? Well, we know that at any time, you can do a transfer from your savings pot into your retirement pot. So the general rule is this: you can always go from a less onerous pot to a more onerous pot. Okay, and why I say that is because remember, your retirement pot is stuck there until you retire or die. Okay, it doesn't get paid out at any time before that. So you can always go from your savings pot to your retirement pot at any time, and you can go from your vested pot to your retirement pot at any time. Now, what we've asked Treasury is we've asked them, well, can we allow this to be limited in terms of the rules, for example? So can we say that, instead of members having this option at any time, so they can do it every day of the week if they want to, can we limit that to say, well, it's once a month or once a quarter or once a year, etc.? And that will be something that we'll have to see once we see what the FSCA will allow in terms of rule amendments. It's also a question we've asked of Treasury in our comment. Okay, so the other thing to mention here, and this is something that Natasha is going to pick up in some detail, is why you would want to do that, right? Why do you want to transfer from your vested or savings pot into your retirement pot? Now, there are two answers that I can think of. The one is, if you're like me and you want to take money out of temptation's way, then you might want to do it. But the second one relates to investments, and Natasha's going to talk a little bit about that in her session. Okay, right. So what else could come into these pots? We've talked about what could come into these pots from the fund and its members. But of course, if you are transferring into the fund, then you could transfer money from another fund into your three pots, for example, by Section 14. So that's another way money could come into these pots. Okay, so if you are a words person and not a picture person like me, then I've put the words on the screen here, and you can see those and go through those in your own time. And Janice has said that you will see the slides and you will see the recording after this.
Yeah, and maybe just, I've seen a question pop up.
Yes.
One of the questions that we've been asked is that for those members making additional voluntary contributions, how would those be split between the access pot and the retirement pot?
Okay, so if you look at the slide, you will see that I've said all or total contributions, right? So as your contributions come in, your additional voluntary contributions are added to that. So it doesn't matter where your contributions are coming in from. They are added together, for want of a better word. Okay. Your expenses and premiums come off them, and then they are split between the 1/3 and 2/3. And exactly the same thing. So your additional voluntary contributions would be added into your contributions, your expenses and premiums come off, and the split happens.
But I suppose you could always, if you wanted to say, well, once a year, put your money from your savings, your 1/3 additional voluntary contributions into your retirement pot.
Yes, so you can.
So that could be a
Yes, so what Natasha's saying is that any time you can say, I want to transfer something from my vested or savings pot into my retirement pot. And that could be, for example, everything that you voluntarily contributed to the fund that is sitting in your savings pot, as an example. Yeah. Okay, right. So those are the words, exactly the same as what we did in the picture. So what I want to deal with now is how pots are paid out. So we understand how it comes in, right? So now we know how our pots are filled up. Our vested pot is already full on the 1st of March 2024 because of everything that we've saved in it. And then our other pots are filled up as of the 1st of March 2024. Right, so how does money leave the pots? So these are the ones I'm going to deal with today. So we're going to deal with the savings withdrawal. Now, this is new terminology and something that we're going to need to get used to. A savings withdrawal is the amount that's going to come out of the fund from the savings pot while the member is still in employment, right? And those are called savings withdrawals. So I'm going to deal with that one first. Then, of course, our normal benefits, withdrawal or exit benefit, where the member's employment is terminating, they're leaving the fund. Death benefits, retirement benefits, and then we'll talk a little bit about immigration and how that is going to, how they think this is going to work going forward. Across all these payments, we have to deal with deductions. And here, I'm talking about 37D deductions. So I'm sure you remember what these are. Our 37D deductions are: 1, housing loans or guarantees. It is misconduct at the employer, where the employers ask the fund to withhold or deduct. It is divorce orders and maintenance orders. So those are our 37D deductions. And we have to deal with those as we go. Right, so let's start here. Let's start with our savings withdrawal. So remember what this is? These are payments out of our savings pot while the member is still in employment. Remember I said to you Treasury's aim, one of their aims was to achieve this payment out of funds while members are still in employment, and this is how it is happening. So this is a new benefit. It's almost like a statutory benefit, right? It's a benefit that the Income Tax Act and the law says you have to have. So what we know is that all fund rules come 1 March 2024 are going to have to allow for savings withdrawals. You don't get a choice as a fund. So funds don't get to say, well, we don't like these. We want our members to keep more money in the fund for retirement. We're not allowing them. This is a statutory almost benefit. You have to allow it. Okay. Now, this is a new rule. So you're allowed to take a savings withdrawal from your fund after the 1st of March 2024 once in a tax assessment year. Right, so you know the tax assessment year runs from the end of Feb to the beginning of March every year. You're allowed one savings withdrawal in that tax assessment year. So let's take an example. Say we are in 2025, legislation's already in. You could take a savings withdrawal on the 1st of January 2025, and then you could take another one on, say, the 1st of April 2025, because it's once in a tax assessment year, not once in a rolling year as it was before. Okay, so new rules on when you can take it. Okay, so we've talked about this. This is a compulsory benefit. It must be allowed for. You don't have to have a reason for it. Okay, so members don't have to say, I'm in financial distress, my wife was retrenched or whatever the story was. There is no financial distress requirements as there was when this was first talked about. So members can simply request it. Now, I've used those words quite carefully. Members can simply request it. Okay, so all your other benefits, like retirement, exit, death, etc., they go through the employer, right? So the employer has things that they have to tell you, right? They have to say the member was retrenched on this date or has retired from employment on this date, and it goes through, your claims process goes through the employer for that reason. But for a savings withdrawal, it's different, right? Because this is initiated by the member themselves. Okay. It is also initiated at the member's request, which we've talked about. Now I want to talk about how much you can take out. So again, remember we're talking about withdrawals from which part? The savings part. Okay. So how much can you withdraw? So there is a minimum amount of 2,000 Rand. And how this works is you have to have 2,000 Rand in your savings pot before you can take anything out. Okay, so if you've got 1,999 Rand, you can't do a savings withdrawal. If you got 2,000 Rand, you can. Okay, so if you've got 2,000 Rand in there, you can take it down to 0. But the moment you've got less than 2,000 Rand, you can't take anything. There's no maximum amount. So if you've got 30,000 Rand in your savings pot, you can take the full 30,000 Rand. Okay, but remember that there may be a fee payable on savings withdrawal amounts. So these are decisions that administrators across South Africa are making at the moment when they look at their costs and in relation to setting up this whole TwoPot process and systems, etc. There may be a fee. So if there is a fee, then how this would be paid out, it would say you were taking out 2,500 Rand. You take 2,500 Rand, the fee would come off that. Let's say it's, and don't quote me on this at all, right? But let's say it was 400 Rand. Okay, so you've got 2,500 Rand, you take off the 400 Rand, you've got 2,100 Rand left, and then tax would be applied for on that 2,100 Rand. Okay, so it's your amount that you're taking out, less your fee, less your tax, and that is what's paid out. Okay, so talking about tax, it's going to be taxed at the member's marginal rate. The way to remember how you are taxed from your savings pot is that if you are taxed on any type of withdrawal, whether it's a savings withdrawal or an exit, then it is always taxed at marginal rates. If it's paid out in terms of death or retirement, then it's in terms of tax tables. Okay, so we're paying out a savings withdrawal here. The member's still in employment, still on the fund. We're paying out what they've requested. It's going to be taxed at the member's marginal rate. Now, something that we've been chatting about before this is that the issue here is that the fund doesn't know what the member's marginal rate is. Okay, because how would the fund know all the income that that member could possibly be receiving? We don't know that. Okay, so the discussion that's going on at the moment is the mechanism by which this is going to be taxed. Okay, so are we going to have to apply for a tax directive on it? We might have to because the legislation allows for it, but the industry has been, and Energy as well, has been making representations to Treasury to say, well, that is not necessarily the best, the most efficient way to do it. Could we perhaps look at something like a pensionable salary or a flat tax rate or a sliding table or something, a mechanism whereby we're not going to have to apply for a tax directive? Because of course, the moment you have to apply for a tax directive, that complicates the process and extends it in time. Okay, so how this is going to work will still be decided, and SARS is still working on that. All right, the other thing about these savings withdrawals is, remember I mentioned deductions, so maintenance orders, divorce orders, housing loans, and misconduct with the employer. So if a member is going to take a savings withdrawal, we need to protect our deductions from those savings withdrawals. Okay, so what I mean by that is that, say there's a divorce order or a maintenance order coming into the fund and the member asks for a savings withdrawal at the same time. Now we've got to make sure we've got enough money to pay the divorce order as well as the maintenance, as well as the savings withdrawal. or the maintenance order at the same time as the savings withdrawal. So we've got to protect our deductions against savings withdrawals. And that what this has meant is that savings withdrawals have become a whole lot more complicated. Okay. So the main idea is that if we can't meet our deduction, then the member should not be allowed a savings withdrawal. But of course, the legislation is a lot more complex than that. It's extremely technical. The way it is drafted is very complex. So let's talk through these. New rules. Now, the other day I was counting how many new rules there are in relation to savings withdrawals, and I counted 11 in total. So there are 11 things that you have to check before you can even see if the member's allowed a savings withdrawal. Now, of course, that means that it's not so simple now anymore. It's not member comes to fund, says, give me money, fund gives the money. Right? Now we've got to check that all these 11 rules, we've ticked the boxes on them. Okay, this makes the process a lot more complicated. All right, so let's have a look at some of those rules. I'm not going to go into them in too much detail, and the reason I'm not going to go into them in too much detail is they might change before the legislation is made final. Let's look at housing loans first. So the legislation talks a lot more about employer housing loans. So this is where the employer has given the member a housing loan. The member is thus making repayments to the employer, right? And here the funder stood guarantee for that loan amount. So if the employer, the member defaults on repayments as an example, then the employer goes to the fund and says, can you pay me that amount? And it calls in its guarantee. Okay, so that's basically how housing loans work if it's from the employer. Now, what I want to talk about here is if the member comes to the fund and says, right, I want a savings withdrawal, but the employer has lent the member money for housing that is guaranteed by the fund. Now, as far as I know, this is like few and far between. I don't know of many employers that give this type of housing loan, so we won't spend too much time on it. But if this is the case, then what the legislation says is that the fund needs the employer's consent before giving the member a savings withdrawal, even if there's enough money in the fund to do both, right? Give the savings withdrawal and give the employer the guarantee that it stood for. All right, so that is the first thing. We hope that this will be extended to other types of housing loans or housing guarantees, for example, where the banks provided it to members or the funders provided it to members, and I'm sure it will be. There is also an overall catch clause in the legislation, and we'll talk a little bit about that a bit later. Okay, so this is the first time where we see, right, it's not so simple now. Now it's not just the fund dealing with the member. Now the fund has got to go to the employer for something. Okay, so that's the first instance. This is the second instance, where there's been misconduct by the member at the employer, and the employer wants the fund to withhold or deduct that. Now, in the circumstance where the employer already has a judgment against the employee, so they've gone to court as an example, and there's already been a judgment issued saying, you, Mr. Employee, owe the employer X rand amount of money in compensation. Okay, so at that stage, you've already got a judgment. So they're saying you've got the judgment now, but it's not been executed. So as an example, it hasn't been paid yet, right? And often this can be quite a lengthy process because now the member doesn't have the money, as an example, et cetera, et cetera. So where there is a judgment, it's just not been executed yet. The fund, the legislation says, may not allow the member to take a withdrawal saving without the employer's consent, except if the fund can pay both. Okay, so if the fund can afford to both pay the employer what is owed or deduct it from the member's benefits, as well as giving the member savings withdrawal, it can do that. But again, right, we've got a complication now because now we've got to approach the employer. Now, this is something I'm not going to get into in too much detail, but you will see more information on this as we send out more publications, etc. But I don't know if you guys remember, there's been this issue in the past, I would think, guys, about 18 months to 2 years, where because of a Financial Services Tribunal finding, employers have been forced to civilly litigate against employees before a fund will accept that it will withhold the benefit. So the first thing the fund says to the employers, have you issued summons? Are you litigating civilly against this member? Otherwise, they will not allow for a withholding. Now, that is likely to change going forward back to what the situation was, a number of years ago, where a criminal prosecution will be enough to allow for withholding in addition to the other requirements. Okay, and the reason that is because they're changing the Pension Funds Act to allow for a Section 300 order in a criminal matter to be enough. It will be a judgment allowing for a deduction. Okay, so that is changing. That's good news for employers and for funds because it does create some certainty. But what happens, again, still in the misconduct situation, what happens if you don't have a judgment yet? So, these things take time, right? You could have issued summons, you're still waiting for it to go to court, or there's a criminal prosecution, whatever the case may be. It takes time. So in that circumstance, the law is changing. The fund will need a court order. So it can no longer, the employer can no longer just come to the fund and say, look, can you please withhold, give them evidence that they require. The fund would then go to the member, here their side. That process will all change. And the fund will have to have a court order. So that means the first thing that an employer will do once they've got this misconduct scenario and they want the fund to deduct is to get a court order. Okay, so that is a change going forward. And once the court order is obtained, the fund must then withhold any payment of benefits, including a savings withdrawal. Okay, so that covers the period up to the judgment. Right, divorce orders and maintenance orders. I can tell you that pending divorce orders and pending maintenance orders, the legislator wants to protect these orders from savings withdrawals. Okay, so what it's saying is a fund must get the consent of the member's spouse before giving the member savings withdrawal. So the member comes to the fund and says, I want my savings withdrawal. Now we've got to ask them the question, is there a pending divorce order? Now, I don't know what pending means, right? It could mean a number of things, right? When my husband had a certain purchase last year, that could have been a pending divorce order, right? But we're hoping that will be clarified. So we're hoping it will mean instituted. So when a divorce claim is instituted, right? And that is defined in the Divorce Act. And it basically means, among other things, when you issue summons. But we'll have to wait and see what clarity that is. But again, now we've got another person in the mix, not just the employer now it's the member's spouse. Okay. The next instance is if you get a maintenance order, if you've already got one, then the member can't take a savings withdrawal unless the fund is satisfied it can pay both savings withdrawal and the maintenance order. Okay, fairly sensible. If there's a pending maintenance order, again, we don't know what that means, but if there is one, then there's this very weird wording that says a fund can refuse a savings withdrawal if there's a pending maintenance order and the retirement fund thinks it can't pay both. But you won't know, right? Because you won't know what that maintenance order is going to say. That's the amount payable. So it's likely that if you've got a pending maintenance order, whatever that may be, a fund is likely to refuse all savings withdrawals. Maintenance courts are quite good at this, though. Often the maintenance officer will tell the fund that there's a pending maintenance order. Right, then in terms of maintenance orders, again, you can go to court and the court can grant an order to a fund to refuse any type of payment of a claim if there's a maintenance order pending. Okay. Right, so that is savings withdrawals, not so easy anymore, like lots of different little rules. And again, this is something that NMG has had to work on quite a lot because, of course, it means changes to processes, changes to claim forms, we've got to think about it in a different way. And we've got to protect personal information. So how do we get the information from the member without disclosing that information to the employer, but still get information from the employer? So it's all that type of thing that NMG is busy thinking about at the moment. Right, let's talk about withdrawal benefits. Okay, so here's our 3 pots: our savings pot, our retirement pot, and our vested pot. Okay, now the member's actually leaving employment, for example, dismissal, retrenchment, resignation, etc. What do they get from the fund? So what they get from the fund on exit is, firstly, and these rules have changed, they can take everything in their savings pot, but you only get one withdrawal from your savings pot in a tax year. Okay, so if you've already taken your withdrawal from your savings pot in that year, you don't get another one when you leave the fund. So you might not get anything out of your savings pot when you leave the fund. The one exception to that is if you've got a very small amount sitting in your savings pot, i.e. you've got less than 2,000 Rand sitting in your savings pot, then you can take it even if you've had a withdrawal in that year. Okay. Now, I can see friction on that between funds administrators and members where they don't understand it. So this is clearly something that we need to communicate very clearly to our members.
And obviously, just to clarify, it's not that you can't get it, your savings pot will transfer to your new fund.
Yes.
Yes.
We're going to talk about, yes, exactly. Thank you, Natasha. So we're going to talk about how we deal with this just at the bottom. Okay, so as we said, remember what I said to you, anytime that money leaves your savings pot and it's a withdrawal, you get taxed at your marginal rate, right? So you get taxed at your marginal rate. Right, then from your retirement pot, you get 0, nothing, right? Nothing from your retirement pot if you're leaving employment. Okay. Natasha will talk a little bit about retrenchments after 1 March 2024, but the rule as it is now, nothing from your retirement pot. Okay. Now, that amount can be transferred tax-free to another fund, right? In terms of your normal your normal transfer process on the payment of a benefit. Okay, we'll talk a little bit more about that in a minute too. Then everything in your vested pot can be paid in cash. But if you were leaving a pension or provident fund now, you could take everything in cash if you left employment. Okay, so that has been protected. And remember, everything that is built up in your fund before 1 March 2024 sits in your vested pot. So the same rules apply to your vested pot, right? If you leave, you exit the fund, you get everything in your vested pot. And it's taxed in terms of your withdrawal lump sum tax tables. Okay, so you can see 3 different taxation bases applied to those 3 pots for the same benefit. Right, this is what Natasha was referring to earlier, where if you are looking at how you take your benefits out of the fund, so whether, for example, you take a portion as tax and then you transfer some to another fund, or, for example, you become paid up in this fund, so you're not transferring anything off, or you're transferring the whole amount off, there are a few rules. Okay, so besides from where you take cash, you can't split your pots. Okay, so what that means is you can't leave your savings pot paid up in this fund and then transfer your retirement pot off, as an example. Right? Your pots have to go together. So they either stay together or they go together. Of course, that doesn't apply to cash. You can take cash from your savings pot if you're allowed, and you can take cash out of your vested pot and then transfer your retirement pot or leave it paid up, right? But you can't split your pots. And that is, I think, going to need a lot more explanation, because there are lots of scenarios that we can think about that might need clarification. Okay, but that's the basic rule. Let's talk about retirement benefits. Right, so now the member has retired. What do they get as a retirement benefit from their 3 pots? So firstly, everything in the savings pot can be paid as cash now, right? That's great. If you don't want cash, you can transfer from a savings pot into your retirement pot on retirement. Okay, but if you want it in cash, you take it in cash. And at this stage, it's no longer taxed at your marginal rates because you've been good and kept it there until retirement. Now it's taxed at your retirement tax levels. Okay, so that is a choice you've made and you're now being rewarded for your choice. Well done. Okay, the next thing is on your retirement benefit is your retirement pot. You get everything from your retirement pot as an annuity. And there's no 1/3 cash, 2/3 annuity, everything from your retirement pot is paid as an annuity or annuities or pension. Okay. Vested pot, you can get part annuity and part cash, depending on annuitization, vesting or non-vesting amounts. Okay, now I'm going to explain a little bit more as we go about that, but let's just accept for now that from our vested pot, right, it all comes out on retirement, and part of it will come out as an annuity, and part of it will come out as cash. Right, so what you can see now is that if you look at the slide, your cash is coming from your savings pot and your vested pot, and your annuity is coming from your retirement pot and your vested pot. Okay. Right, the de minimis amount still applies. So this is that the rule in the Income Tax Act or clause that allows you to say, I've got a very small annuity. I shouldn't be forced to take it as, sorry, I've got a very small retirement benefit. I shouldn't be forced to take it as an annuity because then it'll be a very small amount that's being paid out to you every month, right? We don't want that. So very small retirement benefits have always been subject to this de minimis rule. And the same thing will apply going forward. We'll talk about that. Okay, so everything is taxed as it is now. There's no change to taxation. It's still the retirement lump sum tax tables apply. Let's go back to the vested pot, right? Remember I said to you, part annuity and part cash, depending on those annuitization rules. Okay, so if you look at annuitization, I want you to think of the vested pot as having layers, right? So within this pot, you've got two main layers. Okay, and the first layer is the vested portion of your vested pot. Now, I know that sounds really confusing, okay, and that's why we really like the vested pot to be called something else, but I'm going to try to explain it using the words they've given us. Okay, so within your vested pot, you've got this vested portion layer and this non-vested portion layer. Remember under compulsory annuitization, which came in 2021, there was, for Provident Fund members, there was this whole portion that they'd built up before 2021, and that part of their retirement benefits was still allowed to be paid in cash when they retired. So compulsory annuitization was only about one thing, and that was how much cash can I take on retirement and how much must I annuitize? That's all it was about. Okay, and it put in rules to say this is how much cash you can take on retirement and how much you can take in cash, sorry, as an annuity. So that's why our vested pot, because it's got everything held in the fund before 2024, has got a vested amount from a compulsory annuitization point of view and a non-vested amount from a compulsory annuitization point of view. Your vested portion or amount in your vested pot, that is the amount that you can take in cash. Your non-vested portion in your vested pot, you can take 1/3 as cash and 2/3 you have to take as an annuity. So everything in the green bit there, you can take in cash, and your 2/3 bit has to be paid as an annuity. It's blue like the retirement pot because they both have to be annuitized. Okay, so that is the way it's going to work. Then if we look at our de minimis amount, so if your whole, the de minimis used to look at your whole retirement benefit as well as your annuitization amounts. That is changing. So how de minimis works at the moment, this is what the legislation says, is that you take what's in your retirement pot, you add what is in your whole non-vested layer, not just the 2/3, the whole layer. If that amount is less than 247,500 Rand, you can pay your whole retirement benefit in cash. Okay, so that's the way the legislation puts it at the moment. Okay.
It's going to complicate benefit statements and explanations and everything. It is.
Exactly.
It is very complex. Yeah.
Yeah.
Very.
And that's why I've tried to do it in pictures here. So if you take your retirement pot, you add it to that layer, and it's less than that, you're good to go. Okay. I have to do it in a picture myself so that I could understand what they're on about. Okay.
Put pictures on our statements.
Yeah, exactly. Okay, so retirement benefit done, death benefits. Okay. So there's some very odd wording in the legislation about death benefits. And in fact, the wording of the legislation itself is contradictory to what's in the explanatory memorandum. So I'm going by what I think Treasury's intention will be here, because as it currently is explained, they're talking about, for example, on death, that you can only get an annuity from the retirement part and your cash out of the savings investment part, etc. But in the explanatory memorandum, it says, no, it must work as it does now. So if that is the case, we've made suggestions to Treasury to say, what we need to do is just refer not to pots on death, but simply to the members' minimum individual reserve or amount. Okay, so just to fund credit, basically. Let's just deal with that. So what I think will happen, and this is a highly technical legal term, is I think the pots will smush together on death, right? They'll all come together in one big amount. So like it is now, your fund credit, your minimum individual reserve, whatever you want to call it. And then it'll get paid out as it does now. Beneficiaries will be able to have the exact same options as they do now. They can take cash or elect an annuity, and we know 99.9% of beneficiaries take cash. Right, so we think that that is how it will work, and it then will be taxed as it is now in terms of the retirement fund lump sum tax tables. So we hope sanity will prevail, and that is what will happen. Okay, but of course we will need to wait and see what the final wording says. Let's look at immigration quickly. I'm not going to spend a lot of time on this. So there's a big change that has been suggested for pension and provident funds. Do you guys remember, it was a few years back when this changed for retail funds, so retirement annuity funds and preservation funds, where if you're a member of that sort of fund, you have to wait, if you become non-resident, so you immigrate, become non-resident, or your work visa expires, as an example, because you're leaving and you're now leaving South Africa. If you're in a retail fund like a Pres fund or a retirement annuity fund, you've got to wait 3 years before the fund can pay your benefits out to you. Okay. Now, exactly the same thing is coming for pension and provident funds. So if once 1 March 2024 comes around, then if a member becomes a non-resident or their work visa expires, as an example, they're going to have to wait for this 3-year period before they can get all their pots out of the fund. Okay, so that looks like that is the intention. Again, there's some confusion around the wording, but that looks like it's the intention. What we asked Treasury before, and what we've asked for them again, is can you please allow these members to at least take from their savings pot while they're in that 3-year waiting period, like other members, right? So can you please allow for that? We asked for that before, they didn't give it to us, we've asked for it again.
So Leanne, what if you're not a South African, you're an expatriate, and you're leaving South Africa, leaving the employer? What would then happen to your benefits on exit? Would you still, would the same rules still apply, or would you be able to access all the benefits?
So you're not an expatriate?
You're an expatriate.
Oh, you are an
You're
expatriate.
an expatriate.
But you've been on the fund?
You've been on
and
the
now
fund,
you're leaving.
and now you're leaving,
Yeah.
going back to your home.
So the idea is that the 3-year waiting period will apply.
Still apply, even
Yeah.
though you weren't, you're not a South African
Yes,
citizen.
because usually you'll have a work visa.
Okay,
Yeah, and the legislation then talks about your work visa expiring.
okay.
Okay.
But presumably you could cash your savings withdrawal in 10 days before your
Well, you would think that that's what you would do.
yes, yeah,
Or you
whatever,
would
yeah.
resign from employment or
Yes.
do something cleverer.
Yeah.
Okay.
It's only then effectively then your retirement pot that gets locked.
Yeah. Yeah.
If you withdraw.
Yeah, and that's a sort of advice that people are going to need to approach their financial advisors for, so that you can get an idea of what your options are before this rule kicks in and before you become a non-resident. Okay, so let's talk about, we've talked about benefits now, talked about all those benefits. What about movements between pots? So if we look at movements inside the fund between pots, remember what we said, our seeding amount goes from vested pot to vested pot. You can transfer at any time between the savings pot and retirement pot and between the vested pot and the retirement pot. And there's some very weird wording again in the income tax amendments, which says that you've got to go and get a tax directive to do this. Okay, it's just silly. I don't know why you would do that. And there's no tax event, so I'm not sure why you need to get, this is an admin entry, right?
Yeah, I don't know why. Yeah.
It's an entry on the system, so we hope that that will all disappear and we will continue as normal. Then if you're transferring like a section 14 between funds, you transfer pot to pot, pot to pot, pot to pot. Okay. But of course, once it hits the new fund, the member then has these same options within the fund. Okay. Right, let's talk about this very specific category of older members. So if you look at that little block, I'm talking about someone who fits into all three of these criteria. They're a member of a provident fund, they were 55 or older on 1 March 2021, and they're still a member of the same fund. Okay, so all three. So many of our funds are going to have this category of older member, right? And there are special rules for them. And the main difference is they can choose to be in the TwoPot system or out of it. Okay, unlike active members and other members, this very special category of older member can choose whether they want to be in or out. At the moment, the election is that they are by default in the TwoPot system, but they can elect to come out. Now, I know, Natasha, I've spoken to you about this before as well, and you too, Janice, and we, by commentary through to Treasury, we've asked them to please look at reversing this, to say they're automatically out
as opposed to.
Yeah, exactly, and can opt in. That would make sense, but yeah, at the moment, its default is in. Okay. So, when can they do that? Again, there's questions around this. Is this a once-off option? So do we have to get to all these older members before 1 March 2024 and then suddenly ask them to make their election? Or can they decide after 1 March 2024? Can they change their mind? So can they be in this year, out next year, in this year, out next year? We don't know. Okay, so the other thing is, say they decide they're out, and then in 3 years' time, they say, okay, we're going on. At what stage do you calculate that seeded amount? So the 10% subject to 25,000, is it back to 1 March 2024, which could be quite difficult? Or is it at the time? You know, so lots of questions around this. If they're in the TwoPot system, what does that mean, guys? That means that their contributions are being split between the retirement pots and the savings pot, so they get a savings pot, which means they can take money out while they're still in employment. So that's good, right? That's one thing. But what will happen is that they're in the TwoPot system is that all their contributions after 1 March 2024 will then have to be annuitized, right, when they get to retirement. So they will lose out on that amount, excuse me, being invested from a compulsory annuitization point of view. Okay, there goes my voice. Right, so that is the downside. They will have to take more as an annuity when they retire because they're in the TwoPot system. Okay. If they're out of the TwoPot system, that the plus side is that their contributions continue to be vested from an annuitization point of view, so they will still be able to take all of that amount in cash when they retire. So that's the plus, right? But they will not have a savings pot because, of course, there are no contributions going into that savings pot or retirement pot. So that means they don't get the option of getting savings withdrawal while they're still in employment. Okay, so I suppose it then comes down to, you know, do you need some cash now, or is it more important to you to take more cash when you retire? Like, can you imagine explaining this? to our older members.
100%. I think the financial advisor is going to be critical at this stage, so that members can, I mean, the thing would be the advantage of taking cash immediately. But, you know, if you're 2 years away from retirement, it might be worthwhile to come out and rather have the ability to have more flexibility with what you're going to do with your full amount.
Yes, exactly. And Jonas, imagine explaining that to all your members, right? Say we get the legislation in October, if we're lucky, right? Now we want them to all make that choice before the 1st of March, 2024. Okay, that's a time crunch.
It would be nice if they'd have a few months leeway to make their decision.
It would be nice. Yeah. And you can then do layers of communication. Okay, so let's move on from our older members, because we've talked, I think, enough about them. Retirement annuity funds, they've got the same parts, right? The only difference is that if you're in a retirement annuity fund and you've got more than one so-called policy within that retirement annuity fund, you get one savings withdrawal per policy in every tax assessment year. Not getting more out than other pension and provident funds. You're just getting it more often. Put it that way. Legacy retirement annuity funds can still apply for exemption from the whole TwoPot system, and there's more detail about how they do that now. Let's talk about pres funds very quickly. So I'm nearly finished on my section. Right, if we look at preservation funds, right, let's start with preservation funds that you're already in. Okay, so let's take me as an example. I left an employer about 5 years ago. I transferred my money from my retirement fund into a preservation fund. So I'm already in a preservation fund. Right. Comes to 1 March 2024, what happens? Okay, so how it works is this, is everything that I transferred from that fund into that preservation fund 5 years ago, right, all of that sits in my vested pot. Okay, so it's all in my vested pot. So that means in my preservation fund, I now have a vested pot. But of course, I get the same seeding, right? So I get exactly the same seeding as other members. So 10% of my vested pot, subject to a maximum of 25,000, goes from my vested pot into my savings pot. And it's there on 1 March 2024. But I can also choose at any time to transfer to my retirement pot. Okay, I can always choose that. That's my choice. So I've also got all 3 pots in my preservation fund. Okay, and how it'll pay out is from my vested pots, I can still take my once-off withdrawal if I haven't taken it already, of course. Okay, from my savings pot, I can take my savings withdrawals every year as long as I've got money sitting in there. And my retirement pot, I don't get anything, right? Okay, but of course, all my money is mostly sitting in my vested pot with a small amount in my savings pot.
Because they would only be dependent if you move money
exactly
into your retirement pot. Because come 1 March 2024, you could have just had the seeding going to your savings pot and had that immediate, and had that immediate access.
Yes.
So, and then ignore the fact that you'd ever want money into your retirement pot because you'd be restricted.
That's your choice.
Yeah. And then you could still use the remaining that's in your vested portion and take that full out cash.
Yes, exactly. So for me, everything's going to be in my vested pot except my seeded amount in my savings pot. I can still take my once-off withdrawal from my vested pot, and I get this little amount from the savings withdrawal. So that means I can actually take more money more often after 1 March 2024 than I could before.
So the question here is, let's say you've got a preservation fund, you've got a retirement annuity, and you've got your employer's fund. You technically have 3 access pots that you can draw on an annual come 1 March 2024. From a marginal tax rate, would that potentially not push you out? And you'd have to, yes, you're getting more cash, but you could be paying more tax.
Exactly. So that's exactly right. So,
and that's the difficulty on the tax that we need clarity on, that we need a scale or we need something so that
because
it doesn't push you out.
Because I mean, because it's going to push out all over. So it could be complexities for the employer as well.
Exactly. And that fund doesn't know that that fund is paying out a savings withdrawal, so it doesn't know you've got more income. So that's the point, right? We don't know what a member's income is for marginal rate purposes. Okay, but the point that you raise is important, Janice, in that it's important to understand that the TwoPot system applies per fund. Right? So it's not like one savings withdrawal across all your funds. I often get asked that question. It applies per fund. Okay, so let's talk very quickly about PRES funds after 1 March 2024. Okay, so now I'm a member of a fund. We've gone over 1 March 2024. The legislation comes in, and how does it work with my PRES fund? So it's very simple. You just go pot to pot. So whatever's in your retirement pot goes into your preservation fund per pot, and the same rules apply. You get your once-off withdrawal from your vested pot, right? You get your savings withdrawals from your savings pot, and your retirement pot is stuck there until retirement. Okay, so it's quite simple from a preservation fund point of view. Okay, members who join after 1 March 2024, they'll only have how many pots? 2, right? Because they'll have the savings pots and their retirement pot, because the vested pot is only for money you've already built up before that date. Paid up members, they also get 3 pots, right? So they can actually take a savings withdrawal without coming to the fund and saying, this is what I want to do with my benefit. Okay. We are looking for exemptions for beneficiary funds, unclaimed benefits before 1 March 2024, pensioners, closing funds, liquidating funds, etc. The only one we've heard that we think is fairly certain already is beneficiary funds. Totally going to exempt that from TwoPot. Okay, hopefully the others will also be sensibly exempted. Still a long way to go, guys. These proposals might still change. Still lots of technical amendments sought on the legislation. It's going to go through a comment period. It's going to go through, there's workshops, public hearings, parliament. We hope that we will see the final legislation in October before it goes to parliament. That is my fervent hope, so that we can get all this done. But of course, we're doing what we can now, and that is what Janice will speak to you about in a minute. That's all from me.
Thanks, Leanne. I think the only question, if I've gone through all of them, we've answered. But the only one that came up is that with the 3 parts, would there be a different investment strategy for the 3 parts? And I don't know if we want to answer that now or just pause.
We'll talk a little bit,
cover it a little bit later.
I'll cover it.
Thank you,
Yeah.
Natasha.
Thank you. All right, thanks everyone, and Leanne for that introduction. So I've kind of taken a bit of an actuarial macro perspective and done some modelling on the NMG database. And I was at a Retirement Matters conference a couple of weeks ago and chatting to the other actuaries there from other administrators and other funds. And actually we're all getting exactly the same experience. The experience differs per fund, but it's actually very similar across the industry. And if I look at this, so just starting with kind of unpacking seeding, we want to see like how much, there's been this big National Treasury has been really worried about it. We've had meetings with the Reserve Bank. What is the seeding? How much is it going to be? Is it going to be 10% of the funds? And the modelling we've done shows that those blocks on the left, that across our funds, irrespective of the sub breakdown, we're getting seeding at about 4.3%. And the primary reason for that is the cap, the amounts above 250,000 effectively. And so we don't see that as a big problem. We don't see it as being a particularly big run on the bank in terms of having that capital available on the 1st of March. The asset manager can really, in a typical balance fund, withhold 1% cash for 3 or 4 months, and it would be within their normal mandate, and then they've got a little bit of extra cash to be able to pay, the rush of claims that potentially comes through. So we really don't see overall that being a big problem, and the industry average is somewhere between 3.5% up to about 5 or 6%, depending on your fund. And I'll show a little bit of different industries, different types of funds where that ends up. And you can see there, it's also very similar across most funds. You're looking at about 15–16% of members have fund credits above 250,000. So kind of one in 6 or 7 members have fund credits above 250, and those are going to be capped. The issue we think is going to be the big issue is not so much the big payments, it's not really the middle payments, it's the members below 2,000 Rand or fund credits below 20,000 who are not going to have, their ATM card has insufficient funds, they're not going to be able to withdraw money out of that. And you can see across the NMG database, we're sitting at 41–42%. On our umbrella funds, slightly lower on that, but on our freestanding, some 44% of funds. So that is going to be a big human resource explanation problem for funds, for employers. When members come and say, well, I want my money, well, actually, yeah, the insufficient funds problem. And then the other problem, of course, is the fund credits between 20 and 250, where we probably is going to get the bulk of our withdrawals. And there you can see, for example, on our umbrella fund, potentially 50% of the fund is at that 10% and is going to withdraw, obviously, as well as those above the 250. So that is really what the profile looks like. And we can look at it per different industry. So I've taken, for example, and then just to if we look at it again, just slightly differently, what proportion of members or funds are going to get seeding of only 1%. So you can see like about 2 or 3% of funds are going to have really just 1% seeding. And those are your kind of, your law firm type funds. And then on the other end of the spectrum, kind of about 12, 15% of funds are going to have the full 10% seeding. And those tend to be lower fund credits, or actually more mid-level fund credits, actually. So you higher your fund credits, you lower your seeding, and the lower your fund credits, you higher your overall seeding. And then again, you can see kind of the majority of funds kind of sitting in that 3 to 4% range is where the bulk of funds are going to have that seeding. So that's interesting to know, and it's interesting for the asset managers to know, and in terms of making investment decisions and that kind of thing, it's useful to understand. And then, as I said, I'd unpack some different clients. So this is clients on the NMG database that are in the personal services space. So you can see there, very few in the below 2,000 category, so relatively decent fund credits, slightly overall 4.5%, but a lot in that 10%. So that's kind of those kind of people where we're going to potentially get higher claims on this kind of profile. Our retail, professional services funds, these are your higher paid people, and you can see there are a lot of them, 30% of them in the caps kind of thing, and then very low overall. Again, not so many below the 2,000 and not so many kind of in that middle band. So the profile differs per fund. And then as a last example, our retail, NMG does a lot of retail funds. They do is the majority of our database actually, so which is why it kind of looks very similar to the database, but you can see there kind of some 40% not being able to access their withdrawals. So that's useful to know, and it's going to, as I said, lots of communication around that. And then just to kind of unpack the broader industries across the industry. So the blue line, that links onto the left-hand scale, and that shows the percentage of seeding. So our clients that are in the construction and mining industry, those are on average about 2%. I actually think those are probably clients that consult to the construction and mining industry rather than being the actual miners and builders themselves. And then you can see going up to the public service professional, and then, for example, in the energy sector, quite a high seeding, kind of effectively a low fund credits. The purple bars just is then the size of the funds that we've got. And so you can see the majority of NMG clients are the retail sector, and then averaging at about 5%. Second biggest, then the transport, averaging at about 4%. And third, then our public service clients, averaging at about 3.8%. So that's the profile of that. And then again, we can also just understand how that looks. How does this move between having most of the max? And again, it's the inverse profile. So if you've got few people below 2,000, you're going to have tend to have a lot of people above the 25,000, and that's kind of what the profile looks like. We have included our preservation funds in this stat, and obviously those have got low benefits on average, which is why they're kind of sitting majority of those members or those funds at the below 2,000. And as we're saying, we're hoping we won't have to do savings pot withdrawals. If we can find you, we'll pay you your whole money, not just your savings withdrawal. And so the real crux of this is what does the industry look like? What does the future of these funds look like in 25 years? And so what I've done is I've taken our database and I've projected it in real terms to say how are these funds going to grow and change and whatever. And so what I've done is I've said, assuming we pay out half of the savings pot every year. And you can see the savings pot then sits along at the bottom and it doesn't actually change in real terms, because basically what you're putting in, you're paying out and you get a little bit of growth and you're putting in a little bit more and you're paying out and it just kind of rolls across. That's the little purple line. The blue, the darker blue, deeper blue thing is our total vested pot and some 27 million assets that we've got under management. And that obviously then shrinks in time because, that shrinks in time, obviously, because there's no new money going into those pots. So it will grow, as I said, this is in real terms rather than the scale goes off the chart if I project it in nominal terms. So that's obviously going to shrink in time. But then the light blue line is really then, that's the retirement pot and what Treasury is being striving for, and how that is just then going to grow over the next 25 years.
That's the good news.
That's the good news. And you can see in real terms, the funds will double in 25 years, which is amazing. And in nominal terms, it'll be significantly more than that. And so we tend to find most of our funds they kind of stay very stable. Basically what you get in every year, you pay out in benefits. So our funds in industry-wide don't really grow significantly. So that's kind of, so that's what it's probably going to look like, something there or thereabouts. Obviously, if there was no savings withdrawals and there was full preservation, this is what it looks like. So we actually get a tripling of the industry, but that's unlikely. Yeah. And and depends on so if we get a much lower savings withdrawal, 10% savings withdrawal, we can kind of see how you get a different profile. So that's worth knowing. And then the other thing then, just to talk a little bit on the withdrawal rates. So people are worried, how much are we going to have to pay out? So even with that vesting, we see at the moment funds are sitting at about a 9.5. Some years it goes up to 15 withdrawal rate. If there's retrenchments or during COVID there were a lot of death claims or whatever. But there's not big exits generally. It's about 9 or 10%. So we see this little curve coming in, at a 100% withdrawal rate or 50% withdrawal rate, but it ultimately flattens out as a percentage of assets. And so what that means from an investment strategy point of view is that we don't necessarily need to do something different on our savings pot to what we're doing on our retirement pot, because we're not actually going to have that much. There will be some liquidity for some members, but if I'm going to want to leave my money in the savings pot, I'm not going to necessarily want a short-term investment strategy. And so we're going to need to think carefully about how we do it. And there is the advantage that the money that's locked up, if I go back a couple of slides, let's go to that one because it's kind of the realistic one. That money that's locked up in the retirement pot is going to give us an opportunity to adopt more long-term investment strategies, infrastructure, all of those big projects that our country is looking to get going and building. We can invest in that, but it's going to be such a little bit in the retirement pot that in the savings pot that we really are not going to have to worry, in my personal view, too much about it. It'll differ find a different individual, but it's not going to, the liquidity rush and the run on the bank is not something we really need to worry about. And then I think presented these slides before, but just to kind of recap from an individual member, what does this mean? Is it going to be improved benefits? And yes, in the long run, it will. So what this graph shows is the actuary's ideal. We've been punting that we want full preservation and you should preserve all your money all the way along. Yeah. And so that's the pink line at the top. That's what it looks like. And ignore them. I just used a 20-year-old working till 65, how much money they can have in the fund, and it's a nice curving upward slope. The blue line is the current reality. This is what members do. They work for a couple of years, resign every 5 or 6 years, and take their money out. And they just go back to square one again. And so eventually only about 50 people wake up and say, oh, shit, but okay, I better start saving for retirement. And that's what they end up doing. And so with the two-pot projection gives us kind of somewhere in the middle. And at about 2/3 of the thing, which kind of makes sense because that's going to be 2/3 of your contributions. And so it ends up being not very different from what we say if you were in the full preservation thing, what your benefit looks like if you just took your 1/3 cash, 2/3 benefit pension. So that you can see the two-pot bumpy red line sits just above that kind of bluish middle blue line, which is what your retirement pot is available for you in as a retirement benefit. So effectively what you're doing, oopsie, the slide's not there, is you are taking a third, you are taking in cash from your savings pot what you would otherwise have taken in cash at retirement. Yeah. And it almost becomes a cash flow choice. Yeah. Do I need it at retirement? Do I want to have the 550,000 tax free, or am I happy to pay the tax along the way? And yeah, but effectively a doubling of benefits from the current reality where people are seeing to the current regime or the proposed regime. And the other way to look at it is a bit of mental maths, is to say, so currently, what are people doing? We're currently probably contributing realistically for about 15 years. Now we're going to get approximately 45 years of contributions, assuming a brand new 20-year-old who's starting work now. So he or she's going to have 45 years of contributions, but only 2/3. So 2/3 of 45 is 30 years. So 30 years of contributions versus 15 years of contributions, that doubles it. And then there's a kind of investments rule of thumb is that your money doubles approximately every 22 years in real terms, or every 10 years in nominal terms. So again, your first 22 years contributions will double. And that's how you end up getting kind of 3 times your retirement benefit from the current regime. So I'm not smoking my socks. It is real maths. we will get better benefits. And as I said, it's effectively what this is doing is cashing in your 1/3 benefits at retirement, so that you increasing your pension by not dipping into that 2/3 along the way. There's my slide come out of order. All right. So a couple of other things to think about. DB funds are kind of in the legislation, but very clumsily. The plan, what they're wanting to do with them is they're wanting to cash in service, not contributions. So we'll take 1/3 of your service that you've earned in that year. There won't be automatic seeding. So we'll, and the reason being obviously that the actuaries will need to calculate what your 1/3 is. So, we'll have to do a phased process around that. 1/3 cash retirement still then accrues to you in a pension fund. The complication around this is funds that is actually more the public sector funds, where they actually have a separate annuity portion and gratuity portion, and those haven't been catered for. So that becomes a little bit difficult, and that we're kind of waiting to see. And given that, our biggest fund in the country is the public sector, but they do need to kind of think a little bit more carefully about that. A couple of things you don't think about. If you've got a fund credit offset from your risk benefits, how, you'll need to change your rules so that your savings pot is not offset from that, because otherwise you're going to have to, have different insured benefits. Housing loans, Leanne did speak a little bit about, but those are also potentially problematic because your collateral falls away. And because potentially not allowed access to your retirement pot. We'll still have housing loans on our vested pots for as long as they last. But thereafter, what to do. And obviously, from the Actuarial Society, one of the things we've been doing as well, say, look, it is actually a nice social need that we need housing loan. People need access. So they need to think carefully about that. But I think it's they've put a little bit on the to kick the ball to touch on that one. And similarly on retrenchments, we need people to be able to, if they are retrenched, if they've exhausted their UIF, if they've exhausted their savings pots, they need to be able to access. There's no point in having money tied away. But again, Treasury hasn't mentioned those, and we'll watch the space.
Thank you, Natasha. One of the questions that came up, Leanne, was will Reg 38 apply? So, in other words, any pot that's left behind, is it treated as a paid-up benefit?
Yes, so that sounded like two different questions. Will Reg 38 apply to paid-up members?
No, so if you're exiting, and you've, let's say, only your access pot has been able to pay out, then would your retirement and your vested pot then be paid up, or vice versa?
Yeah, so you can always take your cash and then leave the remaining amounts paid up, but you can't split it. So, for example, you couldn't say, okay, I'm taking my cash from my vested pot, then I want to leave my savings pot in this fund because I can't take it this year, and then I'm going to transfer my retirement pot off the fund. You'd have to transfer your retirement pot and your savings pot off the fund.
Or leave them both behind.
Exactly, or leave them both behind. So you can always take cash from whatever pot you like, but then wherever the pots stay or go, they must go or stay together.
So you make a full election. So if you're taking cash, you'd have the remaining would have to be transferred somewhere.
Transferred or paid up.
Or paid up, paid up. Yeah. So it either stays somewhere together or it goes somewhere together. Yeah.
Okay. Thank you.
Yeah.
I think those were, there's another question that's popped up, but we'll attend to it now. Okay, thank you, Natasha and Leanne. So from an NMG perspective, just some of the things that we've had to think about and to plan for 1 March 2024, and to Leanne's point, it's not legislated, so it's a lot of taking what's being said now and doing the best with what we have. So some of the areas that we need to think about and potential changes are from an administration perspective, and I'll work through that. Legal, what does that entail? What the consulting team are thinking about and what their guidance they're giving to trustees and management committees. Investments, so Natasha's just alluded to it now, but there could be some questions around that. From an actuarial perspective, Natasha's touched on from a DB perspective, and then lastly, communication. So if you look at the administration, some of the things that we've had to look at in the background is obviously from a system development. So we haven't been able to make any changes to the admin system at the moment because we don't know what legislation is going to look like, but we're taking all those scenarios into consideration. So to Leanne's point, how are you going to pay out claims? What are the tick boxes that you need to do? So all of that is being taken into consideration, and then work streams flowing out of that in terms of processes, training, claim forms. All of that is being done in the background. So once legislation goes live, we can almost like an automated tick the box, and we're ready to go. We've needed to think, and to Natasha's point, how many claims are we potentially going to receive come the 1st of March? So Natasha's done some of the actuarial work there. It's given us a good insights on what we can expect. The tax directives is again something that we've questioned, and to Leanne's point is that we're not sure how that interface is going to work between us and SARS. We need to be prepared for that. All our claim forms, any of our other communication that we're providing to members has to be simplified. Leanne's taken us through a lot of the legislative requirements, and it is very complex. So for a member to be able to understand that, we've had to think about, what are the forms going to look like? How do we interact from a call center perspective, administrator, consultant? There's obviously potential changes to service level agreements. Claims need to be paid. We pay claims in a certain service level agreement set time standard. This is obviously very different, so we've had to think about that. What are the potential fees applicable to that? So I know Leanne mentioned 400 Rand. We haven't said anything
No.
about that, but there is, I mean, there's definitely thinking around how would we charge for that. And then reporting. I mean, from an admin perspective, our admin reports are set in a specific way. We might need to relook at that and how do we show what money was paid out from an access pot and how those are split. But the important thing is that we are working around that on the back end. So it's just a matter of, tying it all together once legislation comes through. If we then look from a legal perspective, so obviously one of the big things is rule amendments, and there's a lot of questions being asked about that. And we do think that there could be a potential working group that is formed where there's potential standard wording that can be used for rule amendments. So we'll see that, so that can help from that perspective. And then, as I mentioned a little bit earlier, service agreements that might potentially need to be changed in terms of claims being paid out. From a consulting perspective, we're able to assist with trustee training. So that's something that we have looked at. There's a lot of things for trustees to take into consideration. So we have looked at trustee training, and then from a governance perspective, what needs to be updated from that perspective. If we then look from an investment, I mean, to Natasha's point earlier, there might be a need for an investment strategy change, and some boards of trustees might want to look at certain splits in that. But generally, if you're looking from the database and how many members are exiting and the future exits, it might not necessarily be a requirement. And most funds should have the necessary liquidity availability. Have the necessary liquidity, and that shouldn't be a constraint if you're investing in private equity. But that's an engagement that the consultants would have with those boards, and whatever changes we might need to make there. From an actuarial perspective, Natasha's touched on the DB funds, and then also from on the back end, our data analytics tools. So we've obviously built a lot of assumptions through our smart guide. We'll look at those and see what kind of projections we'll need to take into account the savings spots.
And actually, I forgot to stop you, Janice. What I've got to say when I was showing those profiles per industry is that what we're going to do for each client is we will give each client kind of a one pager, like what does your profile look like? So they can then just they'll just go in the next quarter trustee pack, so that each client's kind of see where they fit in, and we'll compare them to the industry, and if you're an umbrella or a freestanding fund, what that looks like. So
communication, I think this is the big one and the critical one. I mean, Natasha's and Leanne, we've spoken about different member groups. So you've got older members, you've got active members, you've got paid up members. All these members have different rules that will apply to them. So it's communicating at those different levels, explaining to members what their options are. And there's a lot of detail here. So we are looking at how can we simplify it. So providing simplified communication at the moment, just to give members somewhat of an insight of what the TwoPot system is going to entail. But then once legislation comes into effect, how do we break that up and then make sure that members understand at every point what their options are. So there's a lot of work. I think this is one of the biggest areas besides the admin system being updated that we'll have to focus on. And every board is different and every employee is different. So the request that we're getting in, we're taking that back into the business, and we're developing, doing videos, written communication, whether it be roadshows, we'll be able to accommodate that. So it's really engaging with the boards, with the employers, and setting the right strategy for that employer to make sure that we can engage with the members properly. I think, Leanne, one of the other questions that came up, and I know we touched on it quite a bit, but I think it's quite complex that some of our viewers are grappling with, is housing loans, and really that's how it's treated. So I think I think that's something that they've asked just for additional clarity on.
Yeah, so housing loans are complicated under the new system, and the reason for it is also the wording of the legislation. So at the moment, the legislation says you can only make deductions from the retirement pot and from the vested pot, and not from the savings pot. So that means when it comes to making a housing loan or divorce order or any other type of deduction, you can only do it from those two pots. Okay. Having said that, I've done a number of scenarios on paper about when I think that there could be a problem, because you can't make a deduction from a savings pot, and I think that those will be very few and far between. Housing loans have generally been limited to about 65% of the members' benefits in the past. even though the legislation used to allow for 90, rules would generally say about 60 or 65%. So generally speaking, I don't think that housing loans will be too much of a problem, especially because there's this overall section that's been recommended as an amendment to the Income Tax Act that says if you've got any type of deduction and you want to take a savings withdrawal as a member, there needs to be enough left in the pot not to prejudice your housing loan or divorce order or whatever deduction you're making. So I can't think of too many situations where housing loans will be a problem where they've already been given. And going forward, I certainly think that funds will think about the percentage that they will give us a housing loan if they cannot deduct it from the savings withdrawal, and we'll make a decision based on that. So I don't see it as a big issue. I think that going forward, though, the issue that Natasha raised is a different one, which is will you be able to use your retirement pot as part of the guarantee sitting behind a housing loan? So if you can't pay out of your housing, out of your retirement pot as a deduction, that would be a problem. At the moment, the legislation has allowed for a deduction from a retirement pot. But that question has been put to Treasury because, of course, you want to be sure before you start giving housing loans that include the retirement pot.
Exactly. So if they're not, if it's not clear, then that's going to
be a
limit
problem.
loans.
Well, and then to that point on divorce orders. So is a retirement pot excluded from the divorce order?
Yeah. So we've got a big
can a member who's planning on getting divorced transfer the vested pot to the retirement pot and have less available as pension interest?
No, it's different to that, slightly different. So a deduction can be made from a retirement pot.
Okay.
All right, at the moment, in terms of the legislation, can be made from the retirement pot and from the vested pot, not the savings pot. Okay, so the question you've got to ask yourself is, what is the amount or the calculation of pension interest? And that's where they've got it wrong at the moment. So they've said in terms of the new definition of pension interest, it's the amount you would get if you resign from employment. But if you resign from employment after 2 pots, right, what do you get? You can get your vested pot, you can maybe get your savings pot, you don't get your retirement pot. Okay, so that means the amount being split between the parties on divorce doesn't include the retirement pots, and that is totally incorrect. That has to change. It is, it's just not an option not to change that, because divorce lawyers will just not understand that. In my point of view, we have so many problems with, divorce orders that I think that that must change going forward.
Another question is that will the savings withdrawal be different to the current withdrawal, i.e. can a member go directly to the fund to access their savings, or will it be by the employer? And I think to your point earlier, Jan, is that savings is via the fund. So, but there's certain questions that the administrator could potentially have to ask the employer or a spouse or ex-spouse to be, that they'd have to take into consideration.
That's right. So as you say, it's 2 separate processes. The fund and you guys as administrators asking the member for information, and then there may be things that you have to go to the employer and just ask for information. But it is the member that kicks off that process, as you say.
And it does make it difficult though, so if the member's coming for withdrawal, and you'll ask them, is there pending divorce? And they can just say no, what controls and checks and balances do you have? So the employer, I suppose, is at least one avenue, but it's complicated.
One of the other questions is that what will the benefit statements look like? And they definitely have to be showing different pots. And then with your savings pot, almost looking like a bank statement with your cash withdrawal, your transactions on that. So, and that is definitely in the pipeline. I forgot to mention a little bit earlier, but it is something that you got to think about. Also, you're trying to not make a statement too complex. You want to provide all the information that you can, but in a way that a member will understand.
Because members want to know, how much can I get out my savings pot? Let me look at my benefit statement. And they want to know, okay, how much is going to be stuck in my retirement pot if I'm leaving employment? Or let me look at my benefit statement.
And how much am I going to have to take as an annuity, which is going to mix with your non-vested, vested pot?
Exactly.
So it is.
It's quite complex. Yeah.
Another question that just come in is that when a member exits a fund for reasons other than a retirement or death, will that member be able to withdraw the full vested benefits as well as the savings benefit?
Yeah, so that's when we were talking about the exit benefits. And there you can take your savings pot if you haven't taken it that year, or it's very small. The vested pot, you can take all in cash, your retirement pot is stuck there.
So the only time you can't take the savings is if you've had one bite of the cherry this year already.
Yeah.
That's it.
And then one of the other questions was just from a cost perspective is that with the potential any transfer of costs on the admin fee as a result of an admin system update. I mean, I don't think that's necessarily what we want to do, but we're obviously looking at that. And I think that the important thing will be how much you're charging a member to process claims outside of a normal withdrawal and normal retirement. So that member that's accessing the access pot, what is the cost to that individual?
Yes.
I mean, administrators do system updates on a regular basis, and it comes at an expense to the administrator that's not necessarily passed on to the member of the fund. So I don't see that potentially in this case.
But yeah, I think just on that, I think that the key is the member understanding.
Yeah.
That there is going to be a fee, and what it is we don't know yet, and that there's going to be tax. You know, I'm still worried about put your card in the ATM and you draw 2,000 and 1,400 kind of comes out. You know, it's going to be a problem.
For me, I think that the two communication, or three actually communication issues. One is if you take your savings pot, you've got less on retirement, which is what you're saying. The second thing is if you've got less than 2,000 Rand in your in your savings pot, you can't take it.
Yes.
I think a lot of members will not understand that. And the third one is not getting your retirement pot when you exit from employment. There's going to be a lot of members who don't like that at all.
Yeah. And I suppose the other one is the potential 1 March every year, kind of everyone lining up to be paid, which is not going to happen practically.
Exactly.
So we're going to need to phase that through.
Yeah.
And then just for clarity is that where members accessing from the savings part, that request goes directly to the fund. It doesn't go via the employer. It's only where a member's exiting as a proper retirement, withdrawal, resignation. In that instance, would the claim form come via the employer. The other question is funds deposited into the savings or vested pots, are they automatic or a member must give an instruction?
Okay, so it's automatic that your 1/3 goes into your savings pot and your 2/3 go into your retirement pot. That is completely automatic. You can't change the percentage. The fund can't change the percentage. The member can't. It is legislated. Yeah.
But you can do those transfers.
Yeah, you have
the trust fund.
Yeah, at any time.
Yeah. But that's money just going from your savings pot into your retirement pot, as opposed to
or your vested
to
your
retirement.
pot.
Yeah. But and that would be an election, but come 1 March, and that seeding is automatic.
The seeding is automatic, and the split of the future contributions.
And I think that's all the questions that we have.
Good questions.
Thank you so much for your time, Natasha and Leanne. Really appreciate it. Thank you for everybody for joining us. We will make available a copy of today's slide deck as well as the recording from today's session. Thank you for everybody for joining. Enjoy the rest of your day and the week. Goodbye.
Cheers.
Goodbye.